Pre-approval versus pre-qualification. They're often confused, but there is a difference. There is also a difference in how these are handled by your bank or your loan officer. And I always like to think of a loan officer as a mobile underwriter. Our job is to review applications and credit reports and ultimately tell a person or family how much they can qualify for when purchasing or refinancing a home. We're the front line of the approval process. And there is a big difference between a pre-qualification and a pre-approval, and let's just go ahead and jump into it. A pre-qualification is simply an estimate. As a loan officer, we are reviewing the application that you provided us and the credit report that we pulled. Based on that, we are telling you that you could qualify for this product, this down payment, and this type of property. And there are so many variables that come into play that a pre-qualification really doesn't carry much weight. That's why you should always strive to get pre-approved. A pre-approval is verifying the information on your application. We're able to confirm that the information is correct, and we're able to verify what we can use or we can't use. And what I mean by that is oftentimes if you are applying for something, you're going to put in the amount of money that you think you make. But in reality, the amount of income that we qualify you for might be slightly different. Is your overtime income trending down or is it trending up? Did you not receive a bonus last year, but you received one this year? Or are you just starting to receive commission income? All of these can change the amount of qualifying income that we are allowed to use when giving you a mortgage. So it is very important that you take your pre-qualification to the next level, which is getting your documentation into your lender so it can be reviewed and you can be given a proper pre-approval. And the key difference between a pre-qualification and a pre-approval is everything has been verified. And a pre-approval is going to carry a lot more weight in this market compared to a pre-qualification. A seller is more likely to accept your offer if it is a pre-approval versus a pre-qualification. They know that the lender has done their due diligence verifying the information on your application and that you'll be able to perform as a buyer, meeting the contingency dates and ultimately closing on time. Now, when going through the pre-approval process, the documentation that's needed can vary depending on what you do for a living and the type of loan product that you're going to be using. But in general, what you're going to need to provide is the following: 30 days pay stub, 2 years W-2s, and 2 years federal tax returns, and 2 months of bank statements, all pages. Generally speaking, we can complete a pre-approval with just those items. However, depending on what you do for a living, you might need a little bit less documents, or you might need more if you're taking advantage of certain products that perhaps need 3 years of tax returns versus 1 or 2. If you're a business owner and you own more than a certain percentage of your business, we might also need your business tax returns and other information from your CPA or accountant. Now, the turn times of pre-qualification and pre-approval can vary, again, depending on who you're working with and what type of loan product you're using and just you as a borrower. But generally speaking, a pre-qualification is pretty quickly. It can almost be done instantly or take a couple hours at least. A pre-approval just depends on how quickly you're providing the documentation and how quickly it's actually able to be reviewed. Now, the good news is software that mortgage lenders and banks are using are getting more advanced. Generally, you can use AI or other tools to review documents, put things in the right place, and update applications instantly. We're also able to verify some information electronically, like income or assets. So the pre-approval can be pretty quick, just depending on who you're working with and, again, your situation. Now, if you're going through this process and deciding who you work with, here's a couple red flags you should look out for. And the first and foremost is documentation. If you're working with someone who says, don't worry about your documents, we'll get that later after you go under contract, that is a major red flag, and you might want to take a moment to pause and think about moving forward with that bank or lender. It's so important that you get your documentation in and you're working with someone who's capable of reviewing your documents and giving you a proper pre-approval. If they're not asking for things up front, it's probably because they're busy, and you're really going to suffer throughout the process and possibly see delays or major issues come up down the road. Another red flag is if they're not getting back to you quickly. Again, it doesn't take long to do a pre-qualification or a pre-approval. Make sure you're working with someone who's able to accommodate you on your timetable. You're going to have to get pre-qualified before you get pre-approved. It's kind of like the chicken versus the egg. We're going to need your application and your credit report before we can move forward with letting you know the documents that are needed. So we're going to provide you a pre-qualification before a pre-approval, but you can take the financing as far as you want to. One major tip that I want to give to you is look for a pre-commitment or pre-underwriting of your file. In today's competitive landscape, it is more important than ever before that you make sure your financing is solid and you can close on the seller's timeline. Not every seller wants to close fast, but you might be in a situation where that could benefit you and you can outmaneuver your competition by closing quickly. It's much easier to do that with a pre-commitment. First, you should feel confident and comfortable that your financing is secured with a pre-commitment so that you can confidently waive your financing contingency. You can tell the seller that you have not only applied for financing with this bank or lender, you've not only provided them the documentation to verify the information on your application is accurate, but they have underwritten your file. They have said everything checks out, you are good to go. With that pre-commitment, you can confidently waive your financing contingency. Now keep in mind, things can happen, nobody's perfect. There could be changes along the way due to the interest rate fluctuating, changes to your employment, or even changes to guidelines that you didn't account for. So make sure you're staying in great communication with your loan officer before making that offer without any sort of financing contingency in play to make sure you're still good for that type of loan and there's no changes. We always recommend our clients to reach out to us before they write an offer on any property so we can tailor the financing scenarios and tailor the letter to match any offer that they're making. We can also go over how quickly we can close on the loan for them, and again, if they can confidently waive their financing contingency. And if you're new here, my name is Tim Kelly. I'm a loan officer right outside of Washington, D.C., and the purpose of this channel is to help you manage your mortgage and finance your real estate goals. And if you found this video helpful, check out some of my other videos. Check them out. You might find them helpful.